All right. Good afternoon. Today's topic is the typical important three-step top-down process of security analysis. All right. So this is top-down three-step is considered as the best approach in the security analysis. All right. You start with the analysis of economics and security market, first one. Second, industry analysis and company analysis. So macro to micro, right? Macro to micro. So that's the typical significant approach to security analysis, right? So analysis of economics and the security market, across countries, you analyze the government policies and macroeconomic, conditions and policies there. And then within countries, we're talking about which security market have more attractive and have high growth potential. And then move on to industry. So once you identify the attractive security market, you get on to the industry analysis. So you identify those industries attractive or suffering. Suffering because of probably some strike or some regulations. Okay, and then you have to pay attention to several factors. There are business cycles and demographic shift or change in the demand and the supply in the international markets. So those are all significant factor on industry analysis. And then finally, you connect industry analysis, economic analysis, industry analysis, and company analysis. So identify the best stocks in a promising industry, and is based on cash flows, ratios, and future prospect. And then, of course, you have to calculate the intrinsic value and make your decision. Okay. First is economy and market analysis there. Okay. Typical the component is macro analysis. So you look at aggregate economy and security market together, and then another part of the component is micro valuation of stock market. So I'll come back to this one here. I'll introduce two famous and important approaches to a micro valuation there. Now, this graph, if you look at the graph, it will show you the evidence why this top-down approach is important. Now, first graph, if you look at there, x-axis is GDP, that's macroeconomic variable, and then y-axis is corporate profit, right? Corporate profit, company profits there, right? So it shows what do you see there? It's clear pattern of positive relationship, right? So as GDP increases, your corporate profit increases there. So when you choose corporate, when you choose stocks, you have to start with the macroeconomy. It clearly supports this idea, right? And also, if you look at this one here, the second one, the S&P 500 and the corporate profit there, look at this. Corporate profit, that's the corporations, right? Corporations. S&P 500, the stock market. What do you see? Again, it's clear a positive relationship there, right? So macroeconomic analysis, and then corporations and stock market all very closely and nicely related. So that strongly support our top-down approach, right? And there's the important economic indicator. This, leading indicator, coincident indicator, and lagging indicator there. Some economic indicator, they change their direction before the general business and economic condition changes, right? So that's why it is called leading indicator. Right? I'll show you that. That helps anticipate rising corporate profits and possible stock market price increases. Of course, coincident, they move the same pattern, same the timing with the general economy is called coincident. Lagging usually change direction after business conditions have turned around. So if you look at this one, leading indicator, we have all these 10 leading indicator. And coincident indicator, we have this 4, and then a lagging indicator, this 7. All right, Rachel, can you read this leading indicator?
Yeah, I can read it. Okay.
All right.
So 1, average weekly hours of production workers manufacturing. 2, initial claims for unemployment insurance. 3, manufacturers, new orders, consumer goods and materials industries. 4, fraction of companies reporting slower deliveries. 5, new orders for non-defense capital goods. 6, new private housing units authorized by local building permits. 7, yield curve spread between 10-year T-bond yield and federal funds rate. 8, stock prices, 500 common stocks. 9, money supply, M2 growth rates. And 10, index of consumer expectations.
Right. So if you watch the CNBC, you probably hear that like some of this one here, right? So they mention that the average weekly hours of production workers, or sometimes the initial claims for unemployment insurance, or sometimes new private housing unit authorized by local building permits. All these are leading indicators, so they pay attention to this one. If you pay attention to this, the moving direction of this leading indicator, that might give you indication of future business condition and direction. Okay, that's why it's called the leading indicator. If you look at the graph, the first graph, look at the first graph. What do you see there? I mean, the gray area are the economic recession, right? Economic recession. But if you look at the right before recession, look at the right before recession. For example, this one here. This leading indicator is start to change its direction downward even before the recession starts, right? The second one too, it changes direction before this economic recession. The third one, again, right? It goes down this way. And also, if you look at the recession, even before the business and economy it recovers and improves, it starts its direction first, and it's the same way, and here same way. Slightly before it changes, I mean the economy and business changes direction, it start to go up before that. That's why it is called leading indicator, right? And Ellison, can you read these coincident indicators?
1, employees on non-agricultural payrolls. 2,
Mhm.
personal income less transfer payments. 3, industrial production. And 4, manufacturing and trade sales.
Okay, these coincident indicators, they move in tandem with the economic and business conditions. So when the economy goes down, this one goes down simultaneously. And economy goes up, this one goes up there. There's a second graph there. Do you see that pattern, right? It changes, let's look at the last one. It changes direction when the economy is in recession. And it economy got in the recession. When economy recovers, this one recovers. So it's same way. All right, that's why it is called coincident indicator. And Harry, can you read the lagging?
Yeah. Lagging indicators. 1, average duration of unemployment. 2, ratio of trade inventories to sales. 3, change in index of labor cost per unit of output. 4, average prime rate charged by banks. 5, commercial and industrial loans outstanding. 6, ratio of consumer installment credit outstanding to personal income. 7, change in consumer price index for services.
All right. So these are lagging indicator, right? So, this one will change. Let's look at this one. Will change its direction when you are already in the recession, right? Later, after the economy is in recession, and also change in direction after it recovered, right? So this one is called lagging indicators. All right. Now, also another important, component or the attraction is sentiment and expectation survey. It's about consumers. So, just a moment. All right, Miranda, can you read this one here? Consumer expectation.
Consumer expectation relevant as the economy cynical turning points.
Okay.
Consumers' confidence required for consumer spending 70% of GDP.
Mm-hmm.
You want me to continue? University
Yeah.
of Michigan Consumer Sentiment Index, Conference Board Consumer Confidence Index.
All right, good. All right. This consumer spending, what do you call? Consumer spending is called consumption, right? In economy. The consumption, spending by consumer is called consumption. Spending by businesses is called the investment, right? Is a capital investment. Spending by government is called government spending, right? Government spending. And the spending by foreign countries is called our export, right? Net export. So we have those 4 macroeconomic, the spending, aggregate spending. Now, though out of those 4 spending, this consumption, the consumer spending is around 70%, is significant. Substantial amount. 70% is significant amount, the largest portion of national aggregate spending. So consumers expectation, consumers confidence, that is the very important in deciding this consumer spending. And this consumer spending is the significant, the most important driving factor for national economy. You know that, right? So because of that reason, the consumer's expectation or consumer's confidence, that is very important. There are a couple of major data on the consumer's sentiment, consumer's expectation, or consumer's confidence. They're reported there. So 2 important one, is University of Michigan Consumer Sentiment Index. That is that database, University of Michigan Consumer Sentiment Index. Not just this one. They do all different kinds of survey. What consumers expect, or what consumers the sentiment is. About the future economy, about the future interest, about the future the inflation, right? So all those kind of a series of consumers' expectation that is measured by this database. So that's my favorite one. I use that data set often for my research. And Conference Board Consumer Confidence Index, that is by Federal Reserve Bank of Philadelphia and somewhere else. So those are important, consumers' sentiment and consumers' confidence expectation survey is important. And interest rate also is important, right? That is primarily related to the macroeconomic variable related to monetary policy and the cost of their capital and so on and so forth. In micro valuation analysis, this one is trying to estimate the overall market value or overall market condition, right? We learned how to do the free cash flow to equity, that approach, and relative multiple approach. You can apply the same thing for the overall market. For example, S&P 500. S&P 500, we know that that is the proxy for the stock market index, right? So we can apply this approach to the S&P 500. So we can get the feel about, like, the stock market as a whole. But the other two very famous approach, kind of in the category of microvaluation, is Robert Shiller's cyclically adjusted price earnings, the CAP ratio, and Warren Buffett's the total market capital to GDP ratio. Those two are most widely used and famous indicator there. So it gives you important idea about the overall market, right? Let me show you. The first one is the Robert Shiller's index there. Robert Shiller, the first one. The second one is the Warren Buffett. Okay, let me explain this. Look at this. Before 2000, around 2000 or late 1990s, what do you remember? Do you remember anything about the 1990s, second half of 1990s? Anybody?
I don't know if it's right, but I know it's the Black Monday.
Huh?
Is it Black Monday? Is it something to do with Britain? Didn't they were crashing or is that something else when the pound dropped a lot?
Oh, no, that's before that. Before that. This one is unbelievable, like stock market rally. Remember? It's called technology bubble. I think you heard about that, right? Technology bubble or .com bubble. .com bubble. So this huge rally, stock market, the price soaring. This one is, I would say, is baseless. I mean, it's not rational, like the phenomenon. This stock rally, the stock market increase, the .com bubble or technology bubble, that happened without any base, without any supporting base. You see what I mean? That's why it is called bubble, right? So that is what happened around right before 2000. But let's forget about that bubble and let's look at before 2000, the whole thing. If you look at the before 2000, it was around, I mean, it hits like 25. It's like kind of resistance level is 25. 25 is resistance level. So if it get closer to the 25 and then decreased, right? And because this one is an exception. It's right before the Great Depression, right? Great Depression, 1929. That was the exception, right? It's the exception, but mostly it could not go above 25. If you approach 25 and came back down, if you approach 25 and came back down here, 20. So that was looks like 25, looks, the resistance level, like based on the technical analyst, and then it's above 5, right? Above 5. It's fluctuate between 5 and 25. That was a normal, behaving pattern there. But look at this one here. We have very irrational bubble right? The second half 1990s, and after that, what happened is like going down and then going up and up and up and past 30, right? Okay. Now this one is like, yeah, is after 1920s, right? 1920s. This one is like long period of time. So it is, except the Great Depression that hit like 35, except that it was below like below 25, right? But here, 2010, after 2010, we were above 30, and that's why I think you probably heard about stock market, right? They say, I mean, many people say that stock market is too hot, is overvalued right now. Stock market is a little bit too hot. It's like overvalued. Meaning, you look at this here. I mean, 25 reached 25 and then went down, reached 25 and went down. So some people, they say, they predicted that we will have stock market crash. Look at this. It went up above 33, 30, 31, 33. I mean, reached like close to 35. It's too high, way too high, based on the previous pattern. So that's why some people, they predicted stock market crash, or some people say this one is too heated, too hot, too overvalued. So you should be careful. That was the proposition. There was suggestion based on the Shiller's CAP, cyclically adjusted price earnings ratio. So this one is very prestigious and widely used kind of indicator for the overall market. All right, Robert Shiller, he's the Yale professor, finance professor, and I happened to meet him at the conference and had a like 10-minute discussion about something about this, or something about his the previous study. So he's great person. I think he got the Nobel Prize, or probably he deserves it. And then the second one is the Warren Buffett. Warren Buffett is simply the ratio of total market value of the, for example, the Wilshire 5000. That Wilshire 5000, that's the proxy for U.S. stock market, right? So Wilshire, the total market value of Wilshire 5000 to GDP, So if you look at this one here, this one was around the bubble, .com bubble. So I told you it's like the bubble is irrational bubble. It's not rational, irrational bubble. If you if you remove this one, the others are around, but this way, that's. But recently, if you look at that, let me look at this one here. If you look at this one, the GDP, and this is GDP, Greece, and this is the Wilshire 5000. They were around together, but recently, 2010, especially 2014 and above, what do you see? Wilshire, the stock market value that increased much higher, faster than GDP. And then, COVID here, do you see that? 2020, COVID situation that decreased GDP significantly, and then also the stock market this way. But if you look at this one here, stock market is way above right now, recently, way above the GDP pattern, GDP the path. That is another like the evidence that they say, some of them they say, not just Shiller's CAPA index, But this Warren Buffett's this indicator, it shows stock market is too hot now, too heated now. It's overvalued, right? So that's the their suggestion, the proposition. So if you listen to, if you hear that kind of like suggestion, then you immediately you should understand what it is based on. These two, Shiller's P ratio and Warren Buffett's the total market to GDP ratio. Does that make sense? This is too widely used indicator. All right. Next one is the industry analysis there. So once an analyst complete the economy and market analysis, you have to identify which industries are worthy of investment and which industries are likely to be aided by economic trend and the structural changes, right? So the four components of the macro analysis of industry include the following. The following are quite important like factors for industry analysis. The first one is cyclical impact, business cycle, right? And structural impact is a non-business or non-economy related structural, non-cycle the factors. And life cycle of industry, competitive forces within industry. Get this. Business cycle is, is up and down. You see that? Peak and then contraction and expansion, and then trough and contraction, expansion and peak. So, any national economy, if you look at any national economy, you will see that a series of ups and downs, which is called business cycle. That's a typical picture, no matter what the country is. So, but one thing is that one thing related to the security analysis is that different industries tend to perform well or poorly in different stages of business cycle, right? So if you can identify different industries that perform better or poor in certain stages of business cycle, then that could be useful, valuable information, right? So sector rotation, that means they identify the sectors, the industries that will perform like better or poor in certain stages of the business cycle, and then you use that in your investment decisions or trading. That's called sector rotation strategy. Okay, so it's shifting portfolio, your investment portfolio, into industry sectors expected to outperform others based on the macroeconomic forecast. So roughly, if you look at the pattern, after peak, defensive industries usually perform better. So healthcare, consumer staples, utilities, they perform better in the economic downturn, right? Contraction. In the bottom, capital goods industry often perform better there. Financial and technology, they perform better in the recession. And in the expansion, cyclical industries, including consumer discretionary materials industrials, they perform better in expansion. All right. Once you identify this one, now you understand, right? So depending on the stage of business cycle, you can shift your capital investment into different industries, right? So that works. Many people, the groups, they will use this idea in their trading, their investment decisions. Makes sense. And structural economic change, that has nothing to do with the cyclical business cycle. Demographic changes, sometimes oftentimes is crucial to both the demand and supply side. All right, lifestyle, how people live, work, form household, consume, and enjoy leisure and educate themselves, technology and political regulations. For example, one of the demographic shift change recently is like growing population or growing senior population, right? Growing senior population is one like demographic factor right now recently. Now, how that one, how would that should it be reflected in your like security analysis? Now, look at this. If more people, I mean, people just the proportion of senior population increasing over time, then that affects what? That affects healthcare industry, right? It will definitely affect healthcare industry, and that also right affect like some technology related to health related technology, right? And also, you know, previously they work like until 65 and they retire 65 and they retire and they decide to enjoy the post-retirement life, right? But recently, as the senior population and the proportion of aging senior population increases, they usually intentionally delay their retirement. So they don't retire at 65. They retire 70. They wait until 70 or even longer. So that changes like other things like that will impact many industries like healthcare and technology and other in many ways, right? The leisure industry also will be reflected there. I mean, so technology, of course, technology can affect numerous industry factors. Our product or services produced in the new technology can change the industry. That's true, right? Now, politics and regulation, that's significant impact on industries like social value, low regulation, or taxes. That's true. And then also another thing is that important and significant factor for industry analysis is that you remember that, right? Life cycle, product life cycle, right? A similar concept to industry is called industry life cycle, right? Product life cycle, you start with the introduction and growth and maturity and decline, those 4 stages. But industry life cycle include these 5 stages, like pioneering development and rapid accelerating growth, mature growth, stabilization, and decline there. So depending on the stage that a industry is located in this industry life cycle, it affects its cash flow, it affects its profitability and earnings, right? That should be assessed and evaluated. And also another important factor is industry competition structure, right? So industry competition has tremendous impact on profitability, of course. So Michael Porter proposed some system there. I mean, the concept of the competitive strategy described as the search by a firm for favorable competitive position in the industry. So when a company think about a company that is located in certain specific industry. Now, for the company to get profitable and competitive and successful, they have to first figure out the competitive, the position or competitive the condition of that industry. And then based on that, the identification of their competitive position, they have to develop, create their own profitable competitive strategy. Right? So to create a profitable competitive strategy, a firm must first examine the basic competitive structure of its industry, because the potential profitability of the firm is heavily influenced by the profitability of its industry. Okay. All right. Company analysis. That's the last stage. So analysts must understand a company's strengths and weaknesses and calculate the intrinsic value of the company, and then compare that intrinsic value to the market value and make your conclusion about attractiveness of investment in that company or the stock, right? Based on the undervaluation or overvaluation. Okay. Once you identify that, complete the industry analysis. So the industry, once you identify the industry that is attractive and competitive, then you have to connect that result to company analysis. Now, oftentimes the stock of a great company can be priced so high that you should not invest in that company, right? So, or the stock of a less impressive company may be priced so cheaply. Of course, in that company in that attractive industry, right? They're priced so cheaply, so you have to invest in those companies. You have to identify this one, yeah. Okay, so that's why you have to connect industry analysis and then company analysis, and then make your final decision. And another argument for the importance of this top-down, the industry and company relationship, it would be, think about this one here. Like if you suppose you identify a best stock in a not so attractive industry, okay? A best stock in a not so attractive industry. That's one stock. And one stock, one medium level stock, medium attractive as the stock in a best industry. Let's compare those two. Oftentimes, the second one, not so good company in a best industry might be better than the best company in a not attractive industry. That's why you have to do this, top-down approach. Understand that? All right. Before we get into the company stock, let's check some types of the company and stocks. I think you probably heard the growth company, growth stocks, right? Growth company, growth stocks. Growth company usually they have the consistently above average increases in sales and earnings. So they produce higher rate of return than their weighted average cost of capital, right? Their required return, right? That's the company. So their stock produce higher rate of return than other stocks in similar risk level, right? Due to undervaluation. So it results in higher risk-adjusted return. Now, I think you probably heard about growth investment or value investment. Growth investment. Some group, they are proponent for growth stocks. Some people, some group, they are proponent of value. So many times growth versus value investing. That's a hot the topic in the investment industry. Okay? But I'll get back to the value stocks. But growth stocks, if you look at their focus in sales and earnings. There's earnings and earnings growth. All right. So defensive company, more likely to withstand an economic downturn, low business risk, such as utilities, grocery grocery and consumer staples. These are defensive companies, right? Defensive companies usually performs better in like downturn, economic downturn, contraction. So rate of return not expected to decline or decline less than the market, especially during contraction. Okay, they don't produce that like high super return, but they don't like they don't produce real bad return during the economic downturn. Right, cyclical companies and stocks. The sales and earnings are heavily influenced by the aggregate business activities such as steel, auto, machinery industries. If you go back there, cyclical, that include this industry, consumer discretionary materials and industrial, the manufacturing. So they are cyclical industries, cyclical companies, right? So the high changes in rate of return than the market. So when the economy is improving, they produce higher rate of return than the market. But when the economy is going down, they produce lower rate of return than the market. That's called cyclical company, cyclical stocks. Speculative. The speculative the companies that's include the firms whose assets involve great risk but possibly great return, such as the oil exploration. So usually they don't produce that high like probability or high return. So high probability of low or negative return and low probability of normal or higher return. So that's called speculative companies. Quite risky businesses there, right? Value versus growth investing. Let's get this one here. Growth. I told you, growth focus on earnings, right? Sales and earnings, surprise, and our average risk adjusted. But value and growth both are kind of undervalued. However, growth stock or growth investment is based on earnings surprise or earnings growth. But values investing is based on low P ratio and low, price to book or market to book, either way, market to book ratio. They are detected or identified by low P ratio or low market to book ratio. Right? So, this graph, that shows the difference quite well. Now, if you look at this value stocks, that shows low price book ratio, low P ratio, high yield. Growth stock is high EPS, earnings per share growth, and the high profitability, high valuation. So, growth stock, they don't pay attention to P ratio or PBR ratio, yield, dividend yield. But the value, they don't pay that much attention to the earnings growth or earnings surprise or profitability there. They focus on this and they focus on this here, right? So here's an example. One is the upper part is the growth portfolio, The lower part is value portfolio. So the Harbor Capital Appreciation Fund, that's the growth. And there's a T row price value fund is value fund. Now, as you see, P ratio, look at compare this to P ratio. This value fund is very low P ratio compared to the growth fund, right? Value fund P ratio. And then also price to book value is quite lower than this one here, right? Average. But if you look at the earnings growth, EPS, earnings per share growth is much higher for growth stocks compared to value stocks, value fund, right? And then here, high yield, dividend yield is quite higher than growth stocks there, growth stocks. Overall, if you look at the risk risk measure. This grows the risk measure. Beta of risk, the growth fund is quite higher than compared to the value stock. All right. So growth investing, value investing. Now, do you understand the difference between these two, right? So, but historically, if you compare their historical performance, growth versus value, usually value stock, value fund performs better than growth. But still, like there are two different groups. One is go for growth investing, go for value investing. They're still like different groups there. Now, as I said, important thing is that you have to connect industry analysis and the company analysis. Right? So in industry analysis, you identify industry with the attractive profit potential, and also the industry that could be like positively affected by the economic or structural like the trend and factors. Now you also have to given that information, you have to choose the company within those industries, choose the companies that might be better, the more favorably influenced by economic or structural factors, and then with the attractive valuation. That is important too. Attractive valuation, that means if it is like very highly priced, then you have to avoid them. If it is undervalued, then that's the attractive valuation. Yeah. And like you have to identify the firm's competitive advantage there. So defensive versus offensive, low cost leader versus differentiation strategy, and then also how the company is, whether the company has been focusing or consistently maintaining the competitive strategy or not. So this kind of their position in competitive strategies that will probably be important determining factors for their profitability and earnings, right? So this is some more details there. That's why you have to pay attention to that. And also detailed SWOT analysis. SWOT means strength, weakness, opportunity, and threat. Okay, that's called SWOT. Strength, weakness, analysis, weakness, and wait a second. SWOT. This one should be O. Okay, should be O. Okay. So opportunities and threat. Right. So strength. Okay. Strength and weakness. Perceived strengths. That's the good customer service and high quality products and strong brand image, customer loyalty, innovative R&D, market leadership, and strong financial. So these are all strength factors, right? You have to identify those to get the right idea or valuation of the company. Weakness result from the competitors have potentially exploitative advantage of the firm. So any possible weaknesses, you have to show that here in SWOT analysis there. And that was called internal analysis. And external analysis include opportunities and the threat. Opportunities include favorable environmental factors, a growing market for their firms like products, domestic and international, favorable exchange rates, and or identification of their new market or product segment. Threats, unfavorable environment factors, slowing domestic economy. We do have that threat, right? So as I said, we have that. Additional government regulation and increased industry competition, threats of interest. So we have, I told you, right? We have COVID COVID crisis there. We have financial economy crisis there. And then we have also like macro, the climate crisis there. We are facing this with the three crises and threat recently. Right? All right. The next important step is to calculate intrinsic value. I think you did that, right? I told you, PPNL, and what was the next one? General Electrics, right? And what is the third one?
Wasn't it like Goldman Sachs?
Goldman Sachs, yeah, that's right. So that's a whole different industry, right? One is utilities, one is the manufacturing, one is financial. Right? So I want you to have small taste of that valuation there. Right? Okay, we know we did the DDM and free cash flow to equity, free cash flow to the firm, and relative valuation. We did this one here. So important thing is intrinsic value is like your theoretical fundamental value, right? So, theoretical intrinsic value is like that's the amount that you are willing to pay, you are willing to invest in that specific stock, right? Now, important thing is that you have to compare this intrinsic value to the market value. So, if the intrinsic value is about $25, but the market value is about $35, $35, what would be your conclusion? This market value, the current market price is too high compared to the intrinsic value, meaning overvalued. So you don't want to buy those stocks, right? Don't buy stocks. And then if it is $25, the intrinsic value is $25, but the market value is $20 or $19, that is like undervalued, right? Those could be attractive investment stocks. Okay. Now we did this like valuation things in chapter 8, right? So there are some additional insight on valuation. Okay. Can anybody read this one here?
I can read it.
Right. Sure.
Avoid blindly using historic growth or margins. Study the sales mix. Growth rate is influenced by industry life cycle, structural changes, industry competition, and economic trends. Try to distinguish BT, organic growth, and acquired growth. Remember what your cost of equity and beta. When estimating the profit margin, understand the competitive strategy. When doing relative valuation, compared to its historic multiple, competitors' overall industry multiple, and the market multiple.
All right. When you do a valuation is usually like in a valuation team. As a team, you could do that valuation for like investment banking company. But let me just give you one quick thing. When you calculate the growth rate, I told you valuation model, a process, there are three important input there, right? The important input is, the first one is cash flow, right? D1, or the free cash flow to equity 1, free cash flow to the firm 1. So that is the major input. Second one is required rate of return, or cost of equity, or cost of weighted weighted average cost of capital, right? That's the second input. And third input is growth rate, right? Growth rate. If you do this valuation in the real world, I think we covered the one method of calculating growth rate based on financial statement, right? Financial statement. So growth rate is equal to return on equity times return on equity times retention ratio. That was our approach. Like, it's called sustainable growth. But that's oftentimes you will find that sustainable growth is too high. So if you look at the valuation model, D1 over K minus G. If G growth rate is higher than K, you cannot use this valuation model, right? So in that case, that the growth rate is sustainable growth rate is too high, probably you use the actual cash flow over 10 years, actual cash flow over 10 years, and then probably calculate the average growth rate of this like 10-year dividend payout or 10-year free cash flow to equity or 10-year free cash flow to the firm, and then use that growth rate as the growth rate in the valuation model, and you can solve many other, right? And okay, if you look at that, you can understand all those. But organic growth and acquired growth, try to distinguish between organic growth and acquired growth. Now, organic growth is this original, the company's original basic fundamental growth rate. But if the company acquired other companies, different companies, like the smaller companies, but if those acquired companies has high growth, then their overall growth rate will be high, because of the acquired growth, right? Acquired companies growth. So you should be careful about this one too. And what else? Okay, all right. So if the valuation team, they have, of course, we have this like specific model, valuation model, but you have to be more like careful and specific. So you have to discuss all these items, and then you have to come up with your agreement about this one here. And then, if necessary, you have to reflect this some factor or some adjustment into the input, the growth rate or cost of capital, and then cash flow. Cash flow is given. Okay. Finally, if you have high growth companies, then that growth companies. One important thing is that I told you, is it the organic growth or acquired growth? That could be one important discussion. But the another discussion is that how long will the growth continue? How long can the growth continue, that growth, the high growth? No, that's also important input, could be important input there. That question can be answered by this growth duration model here. Okay, look at this one here. G growth rate, D is dividend yield, and then P ratio is here. G is a growth company, A is some like benchmark company or market portfolio, right? The comparison group. So S&P 500, that's the market portfolio. And then high growth company there, you are given this information, P ratio, growth rate, and the dividend yield. Then you put all this number in here, like this. The P ratio for growth rate is 18, right? And then 16, so this one is here. And then 10%, 0.10, 10%, 6%, and then 1.0. If you do this calculation, you get T 4.26 years, meaning, based on this model, this high growth will continue or may continue to grow at 11% at 11%, 18%, right? Okay, for 4.26 years. After that, it will go down. Okay, growth rate, yeah. Okay. Growth rate here, 10% and 6%. Yeah, this is 10% and this is 6%. So this high growth will continue for another 4.26 years. After that, it will come back to the average growth rate, 6%. Right. So this is 10%, and this is 6%. Okay. So that is this model, this growth duration model that answers that question. Is this sustainable if the growth duration is greater than you believe? Okay. Then you advise against investing. So this is one, the method, the quantitative model that answers this question. How long can the growth company continue this high growth? Yeah, in this case, 10%. All right, I think that's it for today. You continue. I mean, you solve the questions there. If you have any question, let me know. Right? Let me stop here. How do you stop?